Welcome to the Explainer. We're always told that gold is the ultimate safe investment, right? So why does its price chart look more like a wild roller coaster? Today, we are digging into the hidden forces that make this precious metal so unpredictable.
All right, let's just jump right in. For what, 5,000 years, gold has been the safe haven asset. It's the thing you're supposed to own when everything else feels uncertain. And yet, if you've been watching its price lately, stable is probably the last word you'd use.
So picture this, early 2026. International tensions are flaring up, and boom, the price of gold just surges, absolutely rocketing to a new all-time high. It looked like it was doing exactly what a safe haven asset is supposed to do. But then, in a complete shocker, it suffered its biggest price drop in 40 years. We're talking more than 12% down. And that left a lot of investors just scratching their heads thinking, wait a minute, how can a safe asset be this volatile? Okay, so to really get what's going on here, we need to peel back the layers. We're going to look at gold as a geopolitical fear gauge. Then we'll dive into this idea of de-dollarization and global debt. We'll touch on the central bank factor, bust some common myths, and finally figure out gold's real role as portfolio insurance. First up, the geopolitical fear gauge. This is probably the most intuitive way to think about gold. It's like a real-time indicator of global fear. You can almost think of it as the market's knee-jerk reaction whenever a big crisis hits. A war, sanctions, major political instability, you name it. And if you look back at history, the pattern is crystal clear. From 9/11 to the 2008 financial crisis and right up to the conflicts we've seen this decade, major global shocks almost always send investors running for the perceived safety of gold. So why is that? Well, think about it. Unlike stocks or bonds that are tied to one country's economy or banking system, physical gold is totally borderless. It operates completely outside of any single government's control. But it's not just about those big, splashy headlines. There are actually deeper, more structural shifts happening in the global financial system, and they're pushing gold right back into the spotlight. And honestly, these are forces that have been building for years. One of the biggest drivers here is something called de-dollarization. Now, this isn't just some buzzword you hear online. It's a real, measurable trend. We're seeing countries all over the world actively looking for alternatives to the US dollar. And this whole movement got a massive shot of adrenaline after something really big happened back in 2022. So what happens? The West froze about $300 billion of Russia's foreign reserves, and that sent an absolute shockwave through every central bank on the planet. The message couldn't have been clearer. Your dollar holdings aren't just a financial tool anymore. They're a geopolitical tool, one that can basically be switched off overnight. And that moment right there, it perfectly highlights why gold is so appealing to a central bank. See, when you hold US dollars, you're basically trusting another nation's policies and politics. But holding physical gold, that means you have an asset with zero counterparty risk. In simple terms, you don't need to trust anyone else to make good on its value. It's a truly neutral asset. It can't be frozen or just devalued because of some other country's political whim. And all of this is happening against a backdrop of just staggering global debt. We're talking $350 trillion by early 2026. Now, when governments owe that much money, there's enormous pressure on them to devalue their own currencies over time, just to pay it all back. And that, of course, makes a finite asset like gold look more and more attractive. Okay, so how is all this translating into actual action? Well, we're seeing the world's most powerful financial players, I'm talking about central banks, making some really big moves that are directly reshaping the gold market as we speak. I mean, central banks, especially in emerging markets, have been on an absolutely unprecedented buying spree. In response to all this geopolitical risk, they've been buying up over 1,000 tons of gold every single year since 2022. They are aggressively diversifying their reserves away from the dollar. But it's not just the central banks. At the same time, regular investor demand in places like the US has just exploded. Take 2025, for example. Investment in gold-backed ETFs, those are exchange-traded funds, made up nearly 2/3 of all gold demand in the US. That's huge. And right here, this is a core reason for gold's recent volatility. See, while those ETFs make it super easy for people to buy gold, they also make it just as easy to sell it. So what happens during a big market panic? Well, investors need to raise cash, and they need it fast. So they sell their most liquid assets, and that often includes their gold ETFs. This can trigger these really sharp, sudden price drops, even when the fundamental reasons for owning gold are actually getting stronger. So all of this starts to get us closer to solving our original puzzle, right? This complex behavior in the market. It lets us bust some of the most common and frankly often misleading myths about gold. Okay, myth number one. Gold always goes up during a crisis. The reality? It's way more nuanced than that. As we just talked about with ETFs, gold often sells off, and sells off hard in the first phase of a panic. It's what they call the dash for cash. Investors are liquidating literally everything, gold included, just to get their hands on dollars.
And myth number two. Gold is this simple, standalone safe haven. Nope. In reality, gold is in a constant tug of war with the US dollar. They're both seen as safe havens. So during a crisis, a ton of money can rush into the dollar for liquidity, which makes the dollar stronger. And since gold is priced in dollars, a stronger dollar can be a major headwind for the price of gold.
So, if gold isn't just this simple one-way bet during a crisis, what's the right way to think about its role in a portfolio? Well, this really requires a pretty crucial shift in how we look at it. And this brings us to what I think is the most important takeaway of all. Gold's volatility, it isn't a bug, it's a feature. It's the signature of an asset that is actively reacting to stress in the global system. Its real purpose is to act as a hedge, a protection, against that slow, creeping erosion of currencies and the sudden risk of geopolitical shocks. To put it simply, gold's true value really shines when our confidence in everything else starts to crumble. Confidence in currencies, in governments, in overall financial stability. And that's exactly why the smartest way to think about gold isn't really as an investment at all, but as insurance. This changes everything, doesn't it? It's not some speculative tool for getting rich quick. It's essential portfolio insurance. I mean, think about it. You don't buy home insurance because you hope your house burns down, right? You own it for protection just in case it does. And it's the exact same idea with gold. Investors hold it as protection against financial chaos. And all that volatility we're seeing, well, that's just the price of that insurance policy, reacting in real time to an increasingly uncertain world.